Let's start at the beginning.
Superannuation universally is about 32 years old this year. Quite a young industry, really, born out of a fight, an industrial fight, which has informed our culture and roots and still does ongoing. Universal super was the idea of someone or a number of people who came out of both the union movement and progressive sides of politics to try and spread that dignity in retirement across more people. So a really progressive social movement, I think, a really progressive idea. What that means is that people forewent a wage increase in order for that to be set aside for their retirement. And the way in which that was done was an agreement between unions and the political class at the time to set up a superannuation system. So the reward of that, of foregoing that, was that there would be a different tax structure. And so super really is just a different tax structure for your retirement savings to go into. But the reason why it's a social and progressive movement is because that sort of system was always really available to public servants, and it was primarily available to men who had a long working career. And so it cut out a number of people in the society. When it was opened up universally, that kind of dignity in retirement and those ideals were stretched across more people in society and primarily stretched across women. So 32 years on, and we're now at a legislated amount of wages that have to be put aside for your retirement, and that means that the sector has grown astronomically and is now rated really highly in the world for its architecture, the way in which it operates, because it's got so many, it's got great governance layers to it, but it's got so much public support as well, and then it has that compulsory nature to it, as in you must set aside some of your money for retirement. So it's been a rapid growth in that 32 years to now nearly being at something like $3 trillion of assets under management, which is set aside to help people retire with dignity.
So what happens to my money once it goes in super?
Well, that depends on whether the member has made a choice as to where that money should be invested. So most members can choose whether they want to invest it straight in equities or straight in private equity perhaps, or straight to a predefined set of a mixture of asset tools. So, for example, we will have something like a balanced or a growth portfolio, and that'll have a smattering of different asset classes underneath it. But it'll be what either the member has chosen, or if they don't choose, every super fund has to have a default strategy. So the money's come in and we know where it has to be allocated to. Let's say a member has chosen that they would like to invest 100% in Australian equities. We can do that as super funds in two ways. The internal asset team in the fund can directly invest into Australian equities, or we can do it by having a relationship with an investment manager who will then choose a series of Australian equities in which to invest that.
Let's hear from one of those asset managers.
The starting point is that a board of trustees give us a series of guidelines to how we're going to invest our members' money in the super fund, and my job and the rest of my team's job is to translate that into an investment strategy. So we have clear objectives of what we're trying to achieve, and then we construct portfolios using different asset classes, equities, fixed income, unlisted assets, in order to achieve the objectives that have been set to us by the trustee.
Okay, so money comes into super as wages foregone. A trustee then sets an investment strategy, and then an investment team decides how to invest. Some of them invest in markets directly, and some of them allocate money to external fund managers to invest. Some of them do both. Tell me more about what fund managers do.
Fund managers take on clients' money to invest that money on their behalf to generate a return. So when I say a return, I'm talking about some sort of outcome that the fund manager and the client have agreed upon that will deliver some improvement in either income or asset value, or a combination of the two over time. And when I say clients, what I'm talking about is it could be anybody who has money to invest. So it could be a superannuation fund, an individual, it could be a company's employees, super funds, it could be a sovereign wealth fund.
Fund managers will manage assets across different asset classes, so everything from the traditional public markets like equities and fixed income through to multi-asset portfolios, alternative assets, and increasingly in terms of private markets, whether that be private debt, private equity, hedge funds, and so on. So I think as many asset classes as there are and as many different ways there are to think about bringing those assets together to deliver outcomes for clients, there are literally that many fund managers.
Overlaid on that, there is active and passive. So the difference between those two categories of fund managers is, in the case of passive, the fund manager is trying to replicate an index. So a group of assets or instruments exactly as they can by mimicking the proportions of the constituents of that index. And so it generally will have a smaller team of people. It may trade less and therefore be able to charge lower fees. And it will only manage to deliver whatever that index can deliver over time. Whereas active fund managers generally will have a bigger team of experts, and they will charge fees on a basis point system across the amount of money they have under management. And they will do a lot of in-depth research and use their skills and experience to try and invest the client's money into whatever asset class they're an expert in to deliver a return that is better than the index or benchmark over time. But they take on more risk, which is commensurate with what the client is requiring from their investments.
How do active managers find good investments?
An active manager like myself, we actually go out, visit companies, figuring out which company not only has a great business model, but run by high integrity people that we trust. And we're also very long-term managers. So we don't think about the day-to-day, quarter-to-quarter. We think about in the next 10 years, which businesses is going to really create value for shareholders. So we actually have a really simple job. We just sit at our desk and think about, our portfolio roughly have 40 stocks, which are the 40 best companies to invest in for the next 10 years globally. So how do we do that? Well, the process is what I call going the hard yard. So collectively, we have 17 people at Cooper Investors, and we do about 1,000 company meetings. And in the Asian team ourselves, we do about 500 meetings just within the Asia region. So we go to the far corners in Vietnam, in Cambodia, in Thailand, the freezing northern region of China. It doesn't really matter where the company is based. We try to visit them. We try to sit across the table from the decision makers and trying to gauge for ourselves if this is a good company. And then we do our usual financial analysis and ultimately come to a view whether or not this is a good company to back.
Or in other words,
in an Australian equity fund manager, there'll be a benchmark, which may be the Australian ASX 200 accumulation index, or it might be a small companies index. And the active fund manager, such as ourselves, will be trying to perform better than what the cumulative capital growth and income growth of that constituent index is over time. And the way we believe that we can do that and add value is that our team, which consists of a portfolio manager and analysts who may have a combination role or they might be split roles, and we do in-depth industry research. We look in-depth into the companies. We build in-depth financial models, and we try and forecast the earnings or cash flows of those companies and come up with a valuation. And then we put forward our investment ideas to our team, and on the basis that we think that this particular company will deliver good returns over time. And we use our skills in portfolio management to pick a group of investment stocks that will deliver an excess above the index over time for our clients. So it's a really interesting job, and I love it. It's really fun.
What about unlisted assets? What are they, and how do fund managers turn them into investment returns?
I suppose just to set the scene a little bit more is that each of the unlisted asset class, there's a spectrum of opportunities. So using infrastructure as the example, you've got very low risk opportunities which have pretty robust cash flows, and then they're principally regulated, and then that moves up to a higher risk category of infrastructure assets where the cash flows are not as certain. So there's a broad spectrum of assets within the infrastructure definition, which is similar for the other unlisted markets or asset classes. So then what you need to do is within each of the spectrum of opportunities decide where you want to play, whether you want to have more unregulated opportunities, which is things like electricity networks, distribution networks that are regulated, whether you want to do more mid-risk assets, which are often airports, ports, more transport assets, or higher risk assets, such as registry services, or in jurisdictions where they are perhaps core infrastructure assets, but there's more uncertainty because of the nature of the market. So you've got a broad spectrum that you can play within for infrastructure, for example. Once you decide which part of those that spectrum that you want to play with, then it's a process of comparing opportunities, which I think goes to your question, how do you compare the opportunities? And that's a relative value and risk assessment that's done. So there's a due diligence process where we get in external advisors, we assess what they say, and essentially it all comes down to a financial model which spits out a return. There's other considerations obviously, like risks, how do you mitigate them, which are outside the model, but they're the things that you also need to evaluate, and also reputational risk if there's anything associated there. So it's a relative assessment of opportunities within specific areas of the spectrum of opportunity set, or clusters as we call it.
Okay, so let's recap. Money comes into super as wages foregone. A trustee then sets an investment strategy, and then an investment team decides how to invest. Some of them invest in markets directly, and some of them allocate money to external fund managers to invest. Some of them do both. These investors then invest across a range of asset classes, scouring local and global markets for the best opportunities. And there's more than $3 trillion currently in the system. Wow, that's a lot of money and lots of activity. What value does that deliver?
Well, I think the key thing is that both from a superannuation fund perspective and also for a fund manager, the objectives that you're set are designed to help Australians achieve their investment outcomes, saving for retirement or saving for a variety of different particular outcomes. Through that, you're benefiting the economy by giving capital to companies, whether or not it's equity or debt, for those companies to invest. You're also providing for the secure outcomes and retirement of hundreds of thousands, and in some cases millions, of everyday Australians.
Because of our size, we can do things that you can't do individually. We can invest in larger properties, we can invest in infrastructure, things that can help society, we can invest in schools and so forth. So the capacity for us to aggregate in that way means that we're able to put money to work into things that I think most people, most communities would value, but likewise it allows people to invest their savings into other areas that they wouldn't otherwise be able to invest in.
There's a growing area of understanding in superannuation around impact investment. So that's investment that delivers a financial return, but also a social return. And we're able to consider this more and more as our skills grow internally, to benchmark those kind of assets, to really figure out what this nation needs in order to move on social issues such as housing. So that being a growing area means that it gets quite a lot of attention, And it's a great fun area to work in because you get to continue that kind of progressive movement that superannuation started with. As in, can this deliver dignity in retirement? Can it deliver a better country? Can it actually float all the boats in the harbour, as they say? Impact investment is not philanthropy. It's just it's a way of looking at investments that has a social measurement as well. And the more we get used to that kind of a measurement, the more those kind of opportunities will come up. And institutional investors like superannuation funds will be able to participate in that. And so if you look around the nation in 10 years' time, you can quite easily see that not only will you as a member be owning airports and roads and ports, but you might also be owning affordable housing solutions, you might also be owning disability housing solutions, aged care villages and things like that that really add back to society.